Hello, everyone. Welcome to Chapter 2 discussion. Using our PowerPoint slides, we'll go over some of the things that should be the most important in Chapter 2 of our textbook, having to do with the 1040 and the tax equation. So, tax return is the 1040, and then in your textbook has three of the schedules. Schedule 1, which is additional income and adjustments to income. So part 1, there are things that are going to be added to the income. Part 2 are things that are going to be subtracted from income to get AGI. We'll talk about that a little bit more in a bit. And then you have additional taxes beyond the regular income tax on Schedule 2, and you have some of the common credits or payments that we'll spend more time on in another chapter on Schedule 3. Again, those, like we talked about in Chapter 1, flow to the 1040. So the detail is found on the schedules. That leaves 1040 to hopefully be just one page and remain, I guess it's a long one page, but that as the tax law goes forward and things are changed. So the definition of adjusted gross income, if you look at the part 2, those are of Schedule 1, those are adjustments to income. Those are things that are subtracted. So when it says gross income minus the list of permitted deductions, those are the ones what we refer to as the permitted deductions. And we'll talk about later, if you're a business, you have a business, anything that subtracts from your business income would also be considered adjustments to income. But those are sometimes referred to as above the line items. So those permitted deductions for AGI are, you might say, more important because some deductions and credits are based on AGI, meaning until you know what your AGI is, for instance, you don't know how much of your, say, medical expenses are deductible, because the law says you can only deduct medical expenses if they're over 7.5% of AGI. So if you have higher AGI, that means that you're going to have a lower amount of your medical expenses that are deductible for an itemized deduction. So that's just one example. There's lots of them in the tax law. And so it's kind of an intermediary calculation that becomes pretty important. And you see that you take the total of line 22 on Schedule 1, and that comes over and goes to line 8A, and so line 8B on the 1040 is your AGI as far as how it's reported. So we've expanded our tax formula a little bit, and we put in this adjusted gross income subtotal, you might say. We've subtracted in, separated out permitted deductions above the line, and these are below the line. So and just because anything that affects here is going to affect this, and it could affect other things as well. So it won't just affect the number going down, it will also affect sometimes credits and other taxes that are based on AGI. So anytime you see a limitation on a deduction or a credit based on AGI, you go, oh yeah, that's why Mr. Nielsen made such a big deal about AGI way back in Chapter 2, is so that we could remember that that's affected by multiple things. All right. The rest of this looks similar to what we presented in Chapter 1. Okay. Now you know where to find the pieces of these on and what schedule they would be reported on. So one of the things about getting your tax liability, but also determining your standard deduction, is your filing status. And that's the next thing we need to review now that we understand a little bit about AGI. So we have 5 filing statuses. Single, married filing jointly are 2. Now notice your determination is on the last day of the year. So, and it's determined by state law. So the marital status of a couple is determined under the laws of the state. So whether you're married or not, the IRS looks to the state law to determine. There's not an individual, a separate federal statute about being married or what that means. That they have deferred to state law. Doesn't matter how many, one or more have income as far as they're married. What happens with married filing jointly is they're literally treated, 2 people are treated as one. Now, they may report children as dependents, but those children are dependents because while they may be part of the household, they are separate in terms of filing. So they would have their own tax return and report their own income. So everybody reports their own income except for 2 people who are married filing jointly. They file together. That's the only group that's allowed to file as one or as a group. Okay? So again, last day of the year, married filing separately. Notice this is married. They're still married. So you cannot be married filing separately if you are divorced. Can't be married filing separately if you're single. It's only if you are married, again, according to state law, but you elect to file separately. All right, so there's some issues. Tax law generally does not like this status, and there's a lot of things built into the law to keep people from choosing this status. Like standard deduction, you only take it if they both make the same selection. Okay, so you can't both take the standard deduction. If one of them itemizes, the other has to itemize. You have to show the Social Security number of the other spouse. Usually it's going to result in more taxes. Once in a while it will save somebody in taxes. Usually this comes up, in my experience, when they're in the process of getting divorced and they really are not feeling like they trust the other individual to pay the taxes or whatever, and so they want to separate the liability. Because if you are married filing jointly and you're both fully liable for the taxes, so the IRS finds out you owe $5,000, they can go after both spouses for the whole $5,000. Now, of course, they stop when they collected just the 5. They don't get 10. They don't get 5 out of both, but they go after both because whoever first to pay, they'll just take that. Now, married filing separately, and I owe taxes, then I'm responsible for mine, but my spouse who's filing separately is only responsible for their income and their taxes. So when you are in dispute, you might say, or having some problems trusting one another, this married filing separately comes up because you're only responsible for your own taxes. Now, head of household, notice, cannot be married. So last day of the year, you have to be divorced or single. Okay. However, we put in the tax law what's called the abandoned spouse provision. You've got taxpayers living apart last 6 months. You could qualify. If you can't. So the idea was a spouse took off. Technically, you're still married because you can't find them to divorce them. But you're providing the household, you're paying for everything, they're not sending you any money, they disappeared. If that's happened for 6 months, then you can, and you you're still technically married, but the law allows you to file head of household because you're like you are divorced or single. All right. So to be head of household, you also have to maintain a household for a qualifying person. You can do that for your parents, even though they live in a separate house. So they could be in a nursing home. If you're paying the bills and supporting them, for parents, that can still be, you can still be head of household, even though you live by yourself and your parents live somewhere else in like an assisted living facility or something. All right. So it's a little more flexible than it used to be as people started providing for elderly parents more and more. Qualifying will. Now, really, this is not a separate status. This is a little bit misleading. Depending on where you look at it, the tax law is sometimes referred to as a separate status, but really this is the same as married filing jointly. You use the same tax tables, the same issues. So don't go looking for a separate tax table or tax rate table for qualifying widowers. It's the same as married filing jointly. Now notice, the only way you can be a qualifying widow or widower is if you have a dependent child. So your wife or husband dies, you get to, in 2019, you get to file jointly in 2019. 2020, the next year, you are single unless you have a dependent child. If you have a dependent child, then you may qualify as a qualifying widower, which means you are allowed to file jointly for 2 more years. The year after they died and the next year, okay? You have to stay unmarried, meaning your spouse died, you didn't remarry. Now, of course, if you remarry, then you'd be could file jointly with your new spouse. And then you must pay, and it's not just have a dependent child, you have to pay for half the cost. They have to live with you, it has to be a child, and they need to be under, for a child that lives with you, so that is a dependent. So again, the definition of dependent, which we'll look at a little later here. So just having lost a spouse does not qualify you as a qualifying widower, all right? It only if you have that child that you're supporting. So dependence. This is a important concept, maybe less so now than it was prior to the new tax law, in that there is not a separate deduction for dependents anymore. That may come back because everything was passed as a temporary situation until 2025. But it's still important to understand who qualifies as a dependent, because it still is part of determining what credits you get, what your filing status is, as we saw for head of household and for qualifying widower. It determines filing status and other matters. So we'll get into the details about dependents in our next discussion.